everybody, welcome back to my channel. This is Vikayo and you are listening to Fixit Finance. Okay, so our topic for today is what I like to call the top 6 downsides of certain universal life and whole life insurance products. Now, why am I doing this video? So just to give you guys a little background, I personally had life insurance as I was 20 years old, I believe. Yeah. And it was a universal life product. I was paying about $50 a month, and then when we got a property, I decided to increase it, and then I was paying $150 a month. So I had these two policies combined for about 8 years. So I know a little bit about universal life and whole life insurance products. So I'm just gonna I don't have the product anymore. I switched my life insurance product to term life insurance. So I'm just gonna be talking to you guys about a few things that I personally found that I didn't like about whole life and universal life insurance products. Now this video by no way in any way sort of form is a I guess it's basically just my opinion. Take it, you know what I mean? Like, it's just my opinion. I just thought I should share so you know what you're walking into when you get a universal life or a whole life insurance product. Okay. So the first thing, I'm referring to my notes on my laptop, so if you see me glance in there a few times, please just bear with me. So the first thing, for a couple of the products, the universal life and whole life, like depending on the one you get, it's possible that the cost of insurance goes up each year. So for example, I mentioned I was paying $50 a month. So say I got it at the age of 20. When I turned 21, the cost of insurance would go up each year. So in a universal life product, for example, the $50 you're paying, maybe the cost of insurance is maybe $25, right? So $25 goes towards paying for the insurance that you have, and then $25 goes into an investment portion. So when I turn 21, what happens is the cost of insurance goes up. So now you have less going towards investments. So that's one thing I didn't like about it. And that's not exactly clear when you sign the documents, and the agent just never explained it to me. The next thing that I didn't like about it is the fact that, so like I mentioned, there's a portion that goes towards insurance, a portion that goes towards investments. So now, if you do decide that you wanted to cash out your investment, or say your investment portfolio in this insurance policy grew to about 50 grand, and you wanted to take out 20 grand to buy a car, one of the things I don't like is the fact that they charge you interest for taking out your money, anywhere from 1 to 3%. And it's not just a one-time charge of 1 to 3%. They charge you, like, I think it's an annual charge. So for every time you haven't put that money back, you're going to have that charge show up. So it's just going to keep depleting the balance of the cash value portion. Anyways, I'll go deeper into details in another video where I go into detail about universal life and whole life. This is just what I don't like about the product. The next thing that I don't like about it is when you die, your family only gets the face value, not the cash value portion. So like I mentioned, you have, say for example, you have a policy that's $100,000 face value, right? You're paying $50 a month for this policy. $25 is going towards the investment portion, and $25 is going towards the insurance portion. Now, if you pass away, if you pay that policy, say for 20 years, and the cash value has grown to say 20 grand, what happens is your family only gets 100 grand. The 20 grand is left with the insurance company for them to do whatever they want with. I personally thought that was not okay. So that's another reason why I don't like the product. The fourth reason why I don't like it, like I said, it's the top 6 reasons why I don't like it. So the number 4 is, if you withdraw the money, so for example, using the same example, 100 grand face value, 20 grand in the investment portion. If you withdraw that 20,000, say you wanted to use it to buy a car, pay for your kids' college, or you wanted to put an addition to the house or whatever, for whatever reason you took out the 20 grand. If you don't pay back the 20 grand before you die, they deduct it from your face value. So your family would only get 80 grand as opposed to 100. Does that make sense? I hope it does. If it doesn't, just let me know in the comments and I would explain further. Number 5, the reason why I don't like the product is the returns are usually crap. They're usually not that great. So like the investment returns. Now, I should put a caveat to that in the sense of, so one of the things that they don't necessarily tell you is the fact that just like with any other investment product, it's not just automatic. They don't exactly move it around for you. You have to pay attention and actually, take your time to pick out the funds that these go into and monitor, the returns and monitor how they're doing and monitor like the fees and whatnot. So, just like with any other insurance product, it's just the returns are not that great. I had it for 8 years and I can say I walked away with, I could have gotten way better returns if I put my money in just an index fund, for example. So the last and final reason why I personally don't like these kinds of insurance products is the fees. For like the first 10 years, you're just paying fees. The bulk of your money goes towards paying fees. So now, what you need to understand about this kind of insurance product is the investment side cannot go into mutual funds or whatnot. They go into something called segregated funds, which is just a fancy way of saying mutual fund for an insurance company. So insurance companies don't necessarily sell mutual funds like through the insurance side. So the segregated funds, they usually perform depending on how the market does, they perform quite okay. The only thing is you pay like an arm and a leg for the security that comes with segregated funds. So for example, if you have debt when you die, your debt and your mutual funds, RRSPs, whatnot, they go into your estate, right? Depending on how your estate and your will is set up. So say for example, you die without a will, everything goes into your estate. If you have debt, the people you owe can claim money against your estate, can come back and say you owe me 50 grand. So because you have an RRSP worth 50 grand, I technically can take that. Again, just an example. If you have a segregated fund, on the other hand, most times they can bypass probate. So what that simply means is they don't necessarily have to go through, the whole estate situation if there's a named beneficiary on it. So in order for you to get that particular benefit, you pay an arm and a leg. It's a lot of fees. So for example, the insurance policy I owned, by the time I walked away, having paid $50, between 50 to 150 when I upped the policy, I think by the time I was done, I only walked away with about $2,000 after owning it for 8 years. Yeah, that's terrible. In terms of, I might as well just put my money under my bed. Anyways, so those are the top 6 reasons why I personally do not like universal life and whole life insurance products. For those that are in their asset gathering and, debt payoff years. It's just not, I don't think it's meant for, it's like the payday lender of the middle class, like Dave Ramsey says. Anyways, that's just my opinion. So yeah, thank you again for tuning into my channel and have a great day.